Inflation, the economy destroyer. Inflation doesn't take a rocket science to figure out that, like during the pandemic time, when you increase the overall money supply by 40 cents, 40%, no matter what you say or do, you just got to take a basic management one intro to business or an economic class at the lowest level. You'll learn that you'll have inflation happen. You may go from a 2 to 3% inflation level that's been on the rolls for a decade and a half, and all of a sudden it explodes and you have 5 to 7% inflation. And then you scratch your head and say, huh, how did that happen? I'm sorry, this is basic economics. When you have this type of a situation, it really damages the entire economy. It especially damages the lower socioeconomic part of our society. Now, that being said, how do you, with your investment, large or small, protect yourself against this economy destroyer? That's part of the secret of being a good investor, making certain you have that broad portfolio. But here's a couple of tips in the process. Inflation erodes the purchasing power of money. When prices in goods and services rise, you can buy less with the same amount of money. For example, a gallon of milk costs $3 today, inflation at 10%. Next year, it's going to be $3.30 a piece. We're seeing these massive changes in the price of gasoline with the desire to try to sit there and force everybody to sit and switch over to electric, except for the fact that some people can't afford to pay the high price for electric vehicles today. And it may be a matter they bought a car and it's in the garage and they want it to last 10 or 12 years. It just depends upon the person. But regardless, when you start having big chunks of your wages being committed to exactly the same products, but at a much higher cost, you reduce the overall buying power for the entire economy. It really hurts the whole thing. The savings, the value of savings decreases over time due to inflation. We have an entire generation called baby boomers that anticipated retirement, and all of a sudden, because we had a recession and followed by inflation, all of a sudden those pensions they have, the 403bs, all the different savings they had aren't even worth to close to what they used to be, and they have to go back in the workplace or stay in the workplace and delay retirement because of inflation. Debt, the burden of debt increases over time due to inflation. If you have a commercial loan, and typically in a commercial loan, you're going to get a commercial loan on prime plus. It depends how much you negotiate on plus. So that being said, you're not General Motors, you're not going to get prime rate, but from a bank. It simply isn't going to happen. You're going to get prime plus another percentage. But the problem that you face is that prime is a moving target when the Federal Reserve decides to go around, hey, let's get together and play around the golf and let's increase all the interest rate for all the banks. Then the banks can sit down there and mess up the economy all they want to. How much do you think we should have? Oh, let's do a 0.5%. Yeah. And so they do a 0.5%, and 3 months later, it really ends up with the people on the other end. All of a sudden, once upon a time, they had prime plus 3, and all of a sudden, that was 6%. Well, wait a minute, 3 plus 3 is prime plus 3. Now it's a 0.5%. Okay, now it goes up 0.5%. But down the line, it may go up 0.75%. But you know what? Let's do it again. And they keep on raising up until finally, all of a sudden, now you find yourself at prime at 7%. And that loan you took out once upon a time, just 3 or 4 years before, and you're paying 6%. Now you're paying 10%. It sucks up the entire economy and dries up your profit. You have to pass the cost on to your people, but you don't want to pass it on too much. So what happens is your profit margin shrinks and shrinks and shrinks. The value of investment, like stocks and bonds, can also be eroded by inflation, which means investors may see their portfolios lose value over time. Invest for the long term. Inflation can be volatile in the short term, but historically, it tends to still move up. And look in your portfolio and rebalance it on a regular basis. Don't stay with the same old thing, because that same old thing was good in the economy way back when, maybe way back when is a year ago. Okay, so rebalance it to adjust to today's economy and pay attention to it and tweak it on a regular basis. If you don't have time, find a financial advisor to give you advice, even if it's a robo-advisor. That is much better than letting it sit and do nothing about the whole thing. Invest in stocks. Surprisingly, I did some research. Some people say stocks have outperformed inflation over the long term. Buy stocks, buy stocks, buy stocks. I think, I don't know if I agree with that at all. Commodities are one of the most volatile items, but sometimes stocks and commodities work. I don't recommend it. Other people recommend it. And I'm not a multi-billionaire, so maybe you need to listen to the other people. But that being said, be cautious about stocks and commodities. They're volatile in a regular situation. In times of inflation, you might actually beat inflation by investing them, although that is not in any advice that I get. But then again, I'm not giving you advice. I'm just telling you about some of the basics. Real estate historically has always outperformed inflation because real estate tends to rise over time. It's a slow moving target, but it's slow and it's steady and it's consistent. It actually is. So invest in real estate. Go out and buy yourself a giant apartment building, 700 or 800 apartments, and you'll be all set. If you can't afford 700 or 800 apartments, maybe you invest in a real estate investment trust. You can get into these for about $5,000 to $10,000 a piece if you have that kind of money to put into real estate investment trust, which is basically a gathering of pool of money to actually purchase a building outright. Then all of a sudden you can sit down and have an opportunity to have a good stable investment. Although if you buy one in an area, in an urban area, and the urban area is taken over by poverty and crime, and you have homeless in the area, your investment will go down in value. So pay attention to where you're investing. And also sometimes real estate, no matter what happens, whether it's big city or small city, if you invest in the small city and the small city has a population that's escaping it, all of a sudden your downtown investment, no matter where you're at in the country, could be down. But also maybe out in the rural areas, it looked good and the world changes. That's when it comes down to rebalancing your investment. There's a whole series of different aspects of it. Here's 4 of them. The equity real estate investment trust. Okay, they really have a good, solid income producing aspect of it because you're collecting rent on a regular basis. You have to make certain the management is doing a good job and that places are in good repair. Otherwise, your overall quality of the facility will go down and your rent prices have to go down. So this all hinges on good management. The mortgage rates, you have that aspect of it, or the equity or the hybrid. Pay attention to this one. These are good, solid investments, usually in the long term, but a lot depends upon the actual facility because this is about real assets. That's why it's different than a financial asset, which is a paper asset. So pay attention. This is stronger, safer, but if you don't have good management, it may be worse than the financial aspects of it. There's one out there you can always get. It's called TIPS, Treasury Inflation Protected Securities. It really is a U.S. bond indexed to inflation and is guaranteed to pay you a certain amount. So TIPS with a principal value of $1,000, inflation is 5%, the bond will increase to $1,050 in 1 year. It's the best thing you get. The government guarantees it. You can buy it yourself through Treasury Direct, a website run through the U.S. Treasury Department or a broker. A broker may charge you something, the Treasury Department doesn't. So there's a lot of merit to it, and it is the ultimate backstop against inflation. A smart move. It ties up your money, except for the fact you're not going to lose any of your principal in the process, and you do really well. Precious metals, for some reason, people think they're valuable. Okay, it's a real asset. So you too can go out and buy some gold bars, put them underneath your bed, sleep on them. It'll be uncomfortable, but at least you'll be safer, and you'll sleep in. Oh yes, I'm sleeping on a great bed. The bed's got full of feathers, and these 3 gold bars right in the middle of my back. Yes, but it feels good because I know I'm secure. Yes, okay. But we tend to always sit down and increase them during different aspects of inflation. There's a limited supply on planet Earth, so that's part of it. That's why it's so desirable. The industry uses them, and it's a safe haven asset a lot of times. During some periods of high inflation in the 70s, the price of gold increased by $2,000. People are going to the dentist, having their gold fillings ripped out of their mouths and sold. I'm really just kidding. That did not happen, except for the fact that people probably thought about it. I can promise you that. In the 2000s, the U.S. has another round of high inflation, and during that time, gold increased by 500%. 500% over a couple of years, that's a massive amount of money. So buying gold actually, or any kind of precious metal during times of inflation is brilliant if you can do it. Sometimes you don't even actually own the gold. You get a certificate, having access to it. But the reality of actually having the gold physically is a good idea, provided nobody breaks into your house and takes it from you. So that being said, the precious metals can fluctuate, and there's never any guarantee However, historically, during times of inflation, the precious metals have increased in value. Real assets, holding that aspect is a good hedge against inflation. Real estate is real property, and that the real part really gives it more value a lot of times than the paper part for a financial instrument. The federal government TIPS program is literally designed to be an inflation shelter. So building an inflation-resistant portfolio, you still want to have a diversity. It doesn't mean that you have to dominate with the real assets, except for the fact it can really help the REITs and the TIPS in the process, gold, silver, the palladium, and so on. All those things, this is rebalancing, and these are good, solid inflation hedge options for you to sit down and make certain you don't lose all your money or it's totally destroyed in the world of inflation, especially in the world of higher inflation than we've been used to previously in our economy. Take care.